Hello, my name is Steve Bigelow with the Candlestick Forum. The market took a knee-jerk reaction today. As we saw, it opened much lower, traded down for a while, but the advantage of the candlestick charts, number one, at the end of the day, told us that there wasn't any strong selling. You can see how the candle turned green, which basically told us that even though the market was down today, they were buying after the open. Another way to see that much more clearly is watching the 10-minute chart, showing that there's bullish confirmation. And you can watch how the market comes back up to confirm the daily chart, especially when it comes back up above the T line. Remember, as we saw in the NASDAQ, where it opened and immediately started trading positive, even though the NASDAQ was down, it was telling us there was buying after the open, not a powerful bearish concept. We were ready for the profit taking because of the simple factors that the Japanese rice traders show us based upon the illustration of the candlestick signals and formations. Gapping up in the overbought condition, that gap up was the alert to say exuberance has come into the market. Get ready for profit taking. So as you have seen in the morning comments, starting right in here, it told us, or I was warning, to be a little bit wary of some profit taking because of this gap up situation. However, without the indexes not able yet to close below the T line, it still makes our candlestick patterns very viable. The reason candlestick patterns are viable, even in a sluggish market, is that the patterns are a buildup of investor sentiment. It was pointed out in our chat room today that there was an obvious J-hook pattern setting up in FRTA. Now, the obvious setup is, look what happened on this little hammer day. Very simple analysis. Human nature is when it comes up through a resistance level, they'll come back and test it to see if it's going to act as support. We could see immediately that with this hammer signal that just touched the 50 and then confirming the hammer signal, that they were confirming support after they hit the 50-day moving average. The benefit of the Japanese rice traders is we could see that occurring immediately, whereas others, once they see that the 50-day moving average is acting as support, that gives them more confidence. They start coming back in. So what's our expectation to the upside on this trade? Wave 1, wave 2, wave 3 being the same magnitude as wave 1. That same setup could be evaluated over in CVET. Notice the T line acted as support and they close right here. This makes for a very simple entry strategy. If they open positive, what do we got going on? Wave 3 starting to be the same magnitude as wave 1, taking you up into this area. And what was the additional confirmation? The fact that they couldn't close below the T line. This makes our recommendation on ENPH. We recommended it on the basis that if it traded positive, well, as you can see, it came down and used the T line one more time as bullish confirmation. And this is what we call the classic pattern. Our fry pan bottom, which creates a strong breakout move, and then our J-hook pattern setup, which has a prerequisite of a strong price move, consolidation. If this opens positive, we've got an extremely high probability expectation that wave 3 is going to be the same magnitude as wave 1. We recommended Zoom because you could see how the T line was acting as a support for this fry pan bottom. Where's the next likely target? Probably what resistance level everybody else is watching, up in this range. And on the bearish side, the candlestick signals work just as effectively on the downside. Look at our bearish best friend signal, a doji followed by a gap down. And a doji followed by a gap down through the T line did a doji today, making this very simple. If this opens lower tomorrow, you've got a bearish best friend gapping down through the T line and now forming a bearish doji sandwich, which implies more downside, or a bearish J-hook pattern. Wave 1, wave 2, wave 3, the same magnitude as wave 1. This information is completely or enhanced by the use of the T-line. We are doing a 2-day training on October 17th and 18th, this Saturday and Sunday. Because of the simple logic that's built into candlestick signals, which are the graphics of candlestick signals are the graphic depiction of investor sentiment, and the T-line acts as a natural support and resistance level of investor sentiment. When you combine the two, you have an extremely powerful analytical tool combination that dramatically improves analyzing when price moves are about ready to occur. You can see this on DY, that slow curve that couldn't get below the T-line. Then you start moving too far away from the T-line, your target is back to the T-line. And then we started recommending, based upon a bullish engulfing signal off the 50, closing above the T-line, if it opened positive, what was our result? First of all, it was confirming the bullish engulfing signal, one of the 12 major signals. And secondly, it was telling us the T-line was not going to act as resistance. That got us into the next price move. We'll probably reiterate a buy because look at the left-right combo, a doji followed by a bullish engulfing signal that bounced off the T-line again, giving us the prospect of wave 3, same magnitude as wave 1. This is not rocket science. This is merely analyzing what the Japanese rice traders have illustrated for years, what is normal human nature. We can do much more trend analysis accurately, knowing what happens when they start gapping up in an overbought condition, profit taking, whether the profit taking is a reversal or just merely consolidation, based upon the intraday charts, the 5-minute, 10-minute, 15-minute chart. That'll be it. We'll see you in the chat rooms.